Everyone, welcome back to our third episode of Unbiased. Today we have Charles Edwards from Capriole Investments. Thanks for coming.
Great to be here, guys.
Yeah, super quickly, I was hoping you could give a background on some of the projects you're involved in and like generally where you're fitting in the crypto space.
Yeah, so I'm the founder of Capriole Investments. We've been in the crypto space, especially Bitcoin, I suppose, from 2019. So essentially systematic trading, Bitcoin and crypto, and in the last 3 years, equities and commodities as well. But yeah, we've been navigating the space for 7 years as a hedge fund, have a couple other businesses under that umbrella, primarily Capriole charts and some analytics that we provide there. But otherwise, we're probably known for creating a lot of on-chain metrics, some obviously on the CryptoQuant platform as well, to help kind of navigate the market, Bitcoin and other assets, but to help navigate when it's over and undervalued.
And yeah, I think it would be a good place to kick off. Just quick on the macro. How much do you follow the macro in your analysis? And generally, do you have a kind of stance on the conditions right now?
I do follow it a lot. Kind of, we approach investing in data top down. So starting from macro, or really being decision making at the top. So Trump, the Fed, interest rates and that kind of thing, money supply, and then that kind of flows down and affects all their assets and markets. So everything's trading in relation to every other asset. So there's this very strong relationships between Bitcoin and gold and equities. So that is a key kind of data point that feeds into our models. On-chain obviously is very important as well. Sentiment data is important, but yeah, various assets, even oil and different assets, they all kind of interplay with Bitcoin and crypto. So you kind of have to consider everything, especially these days. We kind of started that process pretty early on, about 5 or so years ago, but it's even more relevant once Bitcoin kind of hit the sort of $1 trillion mark. When it was a couple $100 billion, it wasn't as relevant because as a small market cap asset, its intrinsic fundamentals were more important, so to speak. But as now it's a bigger asset, it kind of slots into larger portfolios of banks and institutions around the world. You kind of have to consider how all these things play against each other and how these other players in the market consider this data.
So in terms of metrics you look at gauging macro, I know like M2 has been a popular metric, maybe oil, interest rates. Do you have like a key set of like macro indicators you monitor?
Yeah, so definitely. The ones I probably most closely look at on a day-to-day are the ones on Capriole charts, which I could share. There's also a bunch of others not on there, but that's important. I think overall, Bitcoin's still treated as a risk asset. So the fundamental drivers of that are obviously interest rates, money supply, but also the overall health and pricing of assets. So things like the advanced decline line is also pretty important. Want to see some good strength in that as a backbone to equities, which also plays into things like Bitcoin. The put-call ratio for equities is extremely good for Bitcoin as well. And then how assets trade relevant to each other. So something we've seen a lot of in the last 6 to 9 months especially is how Bitcoin's underperformed versus AI, primarily like semiconductors. And it's interesting when you see relative strength between those two asset classes for Bitcoin. So we're talking today, Bitcoin's just hit, I think, 63, 64K this morning on the back of Saylor selling some Bitcoin and I suppose de-risking that model a little bit. But what was interesting in the last few days is you had semiconductors kind of come down a lot last week, and Bitcoin had relative strength there, which it hasn't done for a while. So it is interesting to see how that plays out. But basically, semiconductors have been sucking a lot of capital out of the market. And at some point that may reverse. Maybe we're starting to see that now. It remains to be seen. But those relative signs of strength are also good kind of indicators of where the market might be going.
Charles, just one question that you said you look at some macro indicators like the Fed, interest rates. With this new chairman of the Fed, what are your expectations there? I mean, initially people think that he's more hawkish than expected? What's your take on that? Do you expect some interest rate cuts or not?
Yeah, look, it's hard to know. He doesn't give away much when he talks. If you guys watched the FOMC, his speech a few weeks ago, he basically kept his words very limited. Originally, he's talked about lower rates, but kind of tighter being on the money supply, monetary policy side of things. So that could potentially balance out and not have a huge impact in theory. Obviously, we did see rates being priced in as going up a lot in the last few months. I think a lot of that was on the back of obviously the Iran war and then oil prices going through the roof. And then we started to see some higher inflation readings, as you guys know. And the market basically priced in rate hikes. And that kind of changed really quickly this year, because originally when we came into the year, I think we were pricing 1 or 2 cuts, and now it's kind of flipped. But the interesting thing now that, the war is hopefully ending, at least as a pathway to a peace deal and the Straits semi-open. Obviously, a lot can change in the next 30, 60 days, but provided that holds and oil's now trading below 70, that's really positive. So they have to obviously consider that as a factor that may impact inflation in the coming 6-12 months. It may bring it back down a bit. Obviously, there is a bit of a bullwhip effect, so inflation could go up higher before it comes down, but they'll be considering all these kind of factors. So possibly the market is being a bit too hawkish on where they think the Fed's going. I wouldn't be surprised if there's less hikes than expected, or even if it's just a pause and just wait for 6 to 12 months. The other factor is obviously he's doing these kind of working groups, I think he's called it, into all the different elements of the Fed and how they use data and make decisions. And I think the expectation is end of this year, early next year, they'll have some outcomes there. So he's essentially said that he wants to investigate everything and how they make decisions and then review that model and make some big changes. So it's kind of hard to judge too early until we get some outcomes there. That probably creates some risk factors if they're using brand new data or unproven methodologies that they think are more timely in decision making versus what the Fed's done for almost 100 years. So yeah, you have to kind of be pretty fluid with this, but I think if anything, maybe the market's pricing in a little bit too hawkish for the rates in the coming 6 to 9 months.
You see that as bullish, let's say, for Bitcoin or risk-on assets, if the Fed is not that hawkish.
Yeah, potentially, but it's still not clear how he's going to pull on the monetary supply levers as well. Like, M2 has been coming down a bit the last month or two. So I think there's a bit of uncertainty. We kind of need to see how it all washes out probably this year, right? As he just kind of the transitions and makes big decisions. But yeah, if anything, I think the rate side, it's probably leans slightly more bullish than bearish at this point anyway, if I had to, gun to head, make a decision.
And then I'm curious in terms of, I guess, the cycle theory, because there's always discourse on Twitter and cryptosphere about all these events, macro events, and Fed chairmans, and then Bitcoin always seems to follow this cyclical nature over time. So I'm curious if you subscribe to that idea, or if there's just a little bit more nuance than just this cycle seasonality
a lot of people have been pointing to the old cycles and saying this one's timing wise playing out pretty perfectly, and that's fairly accurate. Like we topped October last year, and that kind of lines up with past cycles. And if you believe in that, then we should bottom in September, October this year. So timing wise, it's kind of playing out. I kind of am skeptical of it. I think it's a little bit of a coincidence this time round. I think there's other factors like the DATs saturating the market about the same time last year, and the quantum threat to Bitcoin emerging in the next couple of years, which I spoke about in October last year as well. And I think that the market's basically been pricing that risk in, and then also the relative opportunity of the AI trade, which is obviously taken off, but it's a hugely, it's an asset class which we all know could have a massive impact on everything we do in life, and we just haven't really had that in the last call it 7-10 years of Bitcoin, every time it's been in a bear market or early stage of bull market, there's never been like some massive ulterior trade that could capture attention that much. There's always been some things, but the AI one, I think we can all agree, is a once in a lifetime or a once in a couple of decade event. So that's consideration. But in terms of the cycle and the impact of miners and that sort of thing on driving price action through a 4-year halving cycle, I don't really believe that is tangible impact going forward, simply because they just have such a limited control over supply now, and the institutions are the key players in the market. So ETFs, treasury companies, if they're buying or selling, or how the capital is flowing across those, is a much bigger impact on price going forward.
Yeah, for just one thing about the cycle. For me, I mean, initially I do think that like the halving had a much higher effect, right? Because the halving was higher relative to the supply, right? So that it had an impact in the initial years of Bitcoin, maybe 2 cycles. Now it's really, like you said, really small compared to all the Bitcoin that is being traded or moved on chain. But I see, cycles as cycles of demand. Demand expansion and then demand contraction, and actually you can see these cycles, with on-chain data, or right now you can also look at the ETFs, right? And so that all that coincided with the 4-year cycle that demand started to contract, probably because what you said, we had these threats to Bitcoin, that's quantum, or that bubble, and then all the AI that suck capital out of Bitcoin, right? But for me, it's more about like those demand cycles. I'm just curious to know how you see the cycle not being as a part of the halving, but everything else, all other things.
Yeah, I think, correct me if I'm wrong, but I think you're saying like you can track various demand and supply metrics and therefore see this pattern of a cyclical behavior, right?
Yeah, exactly.
Yeah. So I agree. I mean, there's plenty of on-chain metrics you can use to do that. And the question, I suppose, is what's the driving factors behind it and what are just kind of more correlated. So, and it doesn't necessarily matter. This is a complex topic, I suppose, for those who are not in the on-chain space. But basically, obviously, everything has if you can drill down to it, and you can't always find it, but everything has like an originating or driving factor. Maybe it's interest rates, maybe it's Trump getting elected, or maybe it's Corona, and then they're printing trillions of dollars. But there's always kind of some driving factor, I would argue at least, which kickstarts the other factors of demand and supply. But you don't always have to know the driving factor if you can see on chain that wallet numbers are going up, or long-term holders are acquiring more Bitcoin, or if there's billions flowing into ETFs and DATs every day and it's outpacing the Bitcoin mining supply, for example. They're all big demand factors which push price up. So sometimes you don't need to know why it is that they're doing that. You can just observe many of these factors and say, okay, on net, there's a lot of demand coming in. That's bullish. That's a new demand cycle, if you want to call it that. So, I mean, I think that's a really powerful way of doing it, for sure. I think if you've got a set of good factors like that you're following, and you're kind of weighting appropriately, and you're looking at a lot, that is really a good way of doing it, for sure. So it's probably more risk-adjusted way of looking at it, because you the macro factor or the driving factor or whatever it may be can change any day, but the net outcome is usually more observable when you look at a suite of metrics like that.
Yeah, I think that's a good point. And I think that's a lot of what we do here as well. Like if you can sort of forego knowing the exact why something happens, but have a set of metrics that shows that this is either fair value, good value, like that is what, if you can avoid the extra
and sometimes the why is like not even knowable, or it's really hard to work out, or sometimes you don't even find out until later in hindsight. So I mean, you gotta monitor a lot of things, as you guys know.
So in terms of, I guess, actual metrics you look at, knowing when is like a good value zone, like what are you looking at in general? Like, is it just suite of on-chain or also a mix of data and relative performance?
I mean, I can share screen if it's to get a bit of a taste at least. This is our little dashboard, strategies on it, and then some screeners. But if you scan down to metrics, we've got a section on macro, Bitcoin, on-chain primarily, then institutional flows for ETFs and treasuries, also for Ethereum. We've got some different macro ratios and sentiment metrics as well. So it's kind of a taste for what we look at. If we're talking about Bitcoin, it's all sorts of things across. So there's a mixture of on-chain and just sort of sentiment-based data here. So this, for example, HEDA is looking at the aggregate long, short weightings in futures, options, and perpetual markets, weighted by market cap. And it's pretty heavily influenced by options in the last months and almost pretty much years now, because it's become a more dominant market. But when it's extended, when people are very bearish, it goes green effectively. So that's been a pretty good local bottom capture. Things like hedge ratio here, there's a few different metrics, ratio of Bitcoin to essentially stable coins. This has also turned green more recently. There's probably a lot going in that chart to discuss here, but to some more classic on-chain metrics like NVT, I still really like. It's one of the oldest ones. Doesn't always work, but generally, when you get a green zone, it's been a local dip opportunity. But yeah, it's a kind of a numbers game of capturing a lot of metrics, focusing on what has higher signal. Also got a put call ratio here for options. So the options market's pretty important for Bitcoin these days. Some classics like Mayer multiple. This one's probably the oldest, I would argue, maybe the oldest Bitcoin metric. And every time it's been below 0.6 has been an amazing opportunity. And obviously below 1 is generally a better opportunity. But we have seen the extremes trend down on this metric, as with many metrics, as Bitcoin becomes bigger. So you guys are well aware of that, I'm sure. But for those who aren't, you see this pretty consistently across data, that the peaks or the extremities of every Bitcoin run has come down, both in terms of return on price, but also an extremity in the market. So this bull run was, as we all know, not that exciting. Only a 2x in the price cycle in terms of price. And a part of that, I think, is to do with the value asset class hitting the trillions, but also the other factors that we've just talked about, I suppose.
So in terms of those, I guess, metrics, because I think generally crypto investment Twitter always looks at these like classic on-chain metrics, MVRV, and they model it against previous performance. And like picking a data point in the past and directly trying to apply it to this cycle doesn't always work, and especially in this last October, right? So I'm curious how you look at on-chain metrics now. Are you like transforming the data? How are you bringing them into the current cycle?
Yeah, I mean, good question. I think that's the problem with a lot of these on-chain metrics. I think there's obviously probably thousands out there now, and 99% are not really useful signals. So people who have been, and this has happened at any stage of the last, since I've been in Bitcoin basically, but you'll always find people at different times point to a metric and be like, oh, look, this is happening. And last time this happened, it was a bottom or a top, and they'll trade that. But then if you like study that metric, there might only be 3 or 4 data points, or it just, there can be coincidences as well that mean it's not that relevant, or the fundamentals behind the metric are just not very sound, or it's overfit the metric, right? And maybe they built it by fitting many power laws and things like stock to flow, right? that just don't work. So there's all those factors where I think experience in quantitative analysis or just maths, right, and fundamentals and drilling down is important. So whenever you see these posts on Twitter, various metrics, most of them you think you have to take with a grain of salt. And if you think it's interesting, before you do anything, you should probably investigate and deep dive that metric. So that's one thing. In terms of how it's evolved, for sure, I think, and this is the same with all models and markets, the more public something is, the more its alpha will leach away over time. And so metrics have a half-life, right? And that's the same in every asset class, equities, whatever it may be. And it's so therefore you need to, be looking for the, new metrics and models and driving factors. I think what you're getting at, like metrics like Mayer multiple here, how the peaks have declined. You want to apply some quantitative approaches like we do, which is Z-scoring things, so that you can capture relative extremes, which may be smaller today than they were in the past, for example. So that's a process of basically normalizing the data. And there's many ways of doing it. It could be normalized between 0 and 1. It could be just standard deviation. But basically, you're just trying to find relative extremes, which may not be fitting the historical mold precisely. And that's a very common quantitative approach that we obviously apply to all our metrics. So that's one element of it. But I think it's less that normalization that's the big factor, but more the introduction of more, the market's always changing. So we didn't have, in pre 3-4 years ago, we didn't have Sailor, any institutions or ETFs or treasury companies, but now that's like the biggest data point, I would argue. So you kind of have to keep abreast with what's driving the market and what data impact that would be having. So yeah, it's basically more metrics and more things to consider now. It's a more complex and more competitive market. You just got way more people looking at this stuff than we did a few years ago.
Yeah, that's why, if you look at those type of metrics like the Mayer multiple or the MVRV or any of the others, none of those, went into extreme levels, right? This cycle. So you wouldn't, if you only look at those, you wouldn't say that we hit a peak for the price and then start a bear market, because you will be waiting to see those extremes. So that's why, like you said, it changes how you need to analyze it. This cycle, I really focus on, besides all those metrics, trying to estimate demand growth. And now you can do it, indirectly with ETFs and with the treasury companies, how much they were buying, and then on chain you can also estimate that. So I really focus on mostly trying to estimate if demand was growing and so or contracting, more than focusing on seeing those metrics at extreme levels. And so that's like you say, that's one thing that you always have to be doing. Coming up with new ways to analyze it.
Yeah, that's a great point. Rate of change can be much more important than the actual value of a metric. And you see that in equities too, right? Like you'll see companies like SpaceX has whatever, a PE of 100 or something, very little revenues compared to any of the Mag 7, and it looks crazy that it should be at multi-trillion. And you see that you get a range of valuations for different assets. Some which look extremely overvalued or undervalued, and they can stay in that asset criteria or ranking for a long, long time. And it's really more about how that company is changing or how its earnings or revenue is changing on a quarter-to-quarter basis or year-to-year basis. So rate of change, like you're saying. Curious what you're seeing with demand at the moment based on your models.
Well, the demand is still contracting. Basically all these entire 2026 has been contracting at different rate. When we hit 57 last week, the contraction hit, like a low or the biggest contraction of the year. Now it's still contracting, but at a much slower level right now. But what I look is, the rate of change, of course, of how much is contracting or more or less, but also, that threshold in which it will indicate that we now switch to demand growing. So I think that's important.
Yeah, the other thing is And of course, it depends what data you're looking at, because all these metrics can have different latencies and lags. Sometimes, key events are more important than what's in the data, if that makes sense. So, for example, the day Trump got elected, right? Coming into that day, it was almost 50-50, or it was, very uncertain. And then within a matter of hours, it became a high probability that he was going to win. And obviously, the market was pricing in very different crypto outcomes on that. And at that point, it doesn't really matter what happened in demand 10, 20, 30 days ago, or even one day ago. All it mattered was that major event. And so sometimes there's events or triggers like that which outweigh everything. So that's important to consider. And the other factor, I think, is just technicals. Can be often as important as the fundamentals, because you could have hundreds of fundamental data points, but maybe you're missing something, or maybe it simply is just taking time for data to flow through those fundamentals, which may be lagging into some respect to impact the market. Whereas price can often respond immediately, or it can price things in straight away. And sometimes it can give you a powerful guidance of where things are going. So you'll have, some of the best investors in the world, like Druckenmiller, Paul Tudor Jones, they will only make a trade or enter a position when it's confirmed with price as well. So technicals. And that works in equities, it works in Bitcoin. And often that can be dismissed as a simple way of doing it, but it can be very powerful. And I think right now, price is actually, or technicals are one of the better things that's we're seeing for Bitcoin. While we've talked about, demand coming down, treasuries, ETFs are selling, the technicals are actually responding reasonably well at, what I'd argue is sort of monthly support at 60K. Then we've had Saylor selling today. Price has actually gone up. And we've seen the last week, the AI trade has kind of struggled, but Bitcoin has outperformed it. So there's some promising signs there. Obviously, it's no guarantee, but they're the kind of things you want to see confirm bullishly as well as fundamentals to help maximize the potential of an investment or a trade there.
And now that you say the technicals, Charles, do you follow or take a look at the 200-week moving average that a lot of people talk about that?
No.
That Bitcoin always bottom around that.
Yeah, no, I don't believe in that. Yeah, people have talked about that as being like a bottom, and we never went below it, right? I think was the story.
But we went below that after the FTX or around that.
Yeah, that's right. Yeah. So we went below it. Yeah. No, I find it's one of those things. The problem with moving averages, obviously, firstly, is what duration you choose. And the longer and longer you choose it, the more and more it's going to drift below price. So you can always find one that will tag every bottom really nicely, or every turning point really nicely. I prefer to see them where there's more interaction with price, to be honest. I find this one's really slow, and you've only had, this is a good example we were talking about before, when you've only got 3 or 4 data points, right? Where 3 or 4 points where it's touched or crossed really nicely, and therefore people think it's great, but it's just not enough to be meaningful, and it's probably more likely to be noise and coincidence, in my opinion. So I find the 200 week, is way too slow.
And I do want to ask you about digital asset treasuries, DATs, because I think this cycle, DATs and ETF inflows are 2 like huge new sets of data points. So I guess broadly, are you monitoring all of that in your investment?
Yeah. I think we were the first to publish the net buying and selling metrics for DATs. The blue line here is the net buying and selling of treasuries and ETFs. The gray line is 0. So it's a percentage of market cap, this metric. Orange is the DATs and green is the ETFs. So, right, and red is the Bitcoin mined per day. So when the blue line is above the red, this is green, and it means that there's more buy institutions of Bitcoin net supply added to the market from mining. And that's where we've seen all the biggest price appreciation of Bitcoin since 2020, basically. So obviously it's gone kind of negative more recently from about, 80K, 78K or something around there. And that's been primarily driven by ETFs unloading. Probably a lot of that recently around the AI trade sucking capital out. But the DATs kind of held pretty strong until recently. About 3 weeks ago, they really started buying way less than normal, near some of the lowest accumulation rates in the past. And so the net selling has been about 400% of daily mined Bitcoin supply. So this is really important for me. Like, I think if you want to position with size and capture a lower risk trend, then you want to be in the green zones effectively, which is when there's net buying. Obviously, you're not going to get every price run, but you get most of the major ones. The market will usually bottom when it's red, like now, so that could be a potentially positive way to look at it. But you can also stay in these red zones for a long time, like we did for 2 years. So you'll often see people say, well, they'll zoom in. That's the other thing on Twitter. They'll zoom in like to a period where it makes most sense to their argument and say, oh, well, every bottom was when it was red, so it's bullish, right? And maybe they're right? It could be right. But then if you zoom out for multi-years and lots of data points, you'll see it was red for years. So that's another area you have to be careful with what you see online and just do your own research. And also we've got Saylor now basically selling for the first time in proper size. What was it, today or the last day? So this is probably going to drop down again soon. So it'll be interesting to see where this all unfolds. But yeah, I'd like to see this flip green, and price could be much higher at that point. Like we talked about, there is lag in some of these metrics, but it's about the confluence of data points that you want to see. You can also track the buying and selling ratio, which is still a bit obviously red today. You can look at debt ratios as well of these companies, which have been going up to their highest point ever. Still not, if you compare to normal equities, not deeply concerning. So it's just a trend that makes this whole industry, in my opinion, unsustainable long term. But right now, it's not like a big price risk. It's just that, I just don't see a future for many of these companies. But yeah, we could talk about this for the whole show probably. So I'll probably just pause there.
Yeah, I definitely wanted to ask your broad opinion on that. Do you think there's a actual innovation happening? Because you're obviously tapped into equities probably a lot more than we are. So I'm curious your take on that.
No, I don't think there's an innovation happening. So I've done a couple of presentations on this if people want to get more context. But basically, DATs are basically companies that are saying they'll raise money to buy Bitcoin. And that's not a new model. It's happened in the 1930s. They were called investment trusts, and they did the same thing to buy equities. And at the time, they were saying, equities were limited in supply, and they were taking on leverage to buy more. And, there was the same arguments, just for a different asset. The problem is it's just not a sustainable model because it's a fixed supply asset. And the only way they can deliver a benefit to investors if they have a Bitcoin yield, so positive growth in the Bitcoin per share. And the only way they can grow the Bitcoin like that is to either issue equity when the MNAV or the value of the company is more than the Bitcoin, or by taking on debt. And in a bull market, all these companies have a lot of hype and they trade at high multiples, and they can issue equity and buy more Bitcoin, and that's great for everyone. But then you get bear markets like this, or you just get market saturation where you got 200 DATs like we have now. And the only way they can do that is by basically using debt. And I talked about this back in October last year as one of the biggest risks for the market. And back then there was not much debt in the market, and it's basically just gone straight line up since then. We see MicroStrategy, a ton of debt, and then now got guaranteed yields with STRC, which is totally unsustainable. They're guaranteeing 12% return on an asset, which must have Bitcoin outperform that to give that return. And historically it has, but there's no guarantee that Bitcoin's going to go up over that amount every year forever. And in fact, it's most likely not to in the long run. So they're incentivized to take on debt, because if you don't, right, if you're a DAT that does nothing and you do things very conservatively, you've got 199 other DATs out there. And if they start using debt to buy more Bitcoin, and grow their yield and give investors a better return, then you're going to want to do it too. And at some point, the debt ratios, I think, become really concerning and a massive leverage risk to the market, right? And we know, if anything, we know that people in Bitcoin and crypto love to take on leverage risk, and it always unwinds at some point. So I'm not expecting that to happen right now. Like the ratios, while they're the highest they've ever been for DATs, they're still below anything like that's an immediate red flag, I suppose, versus equity. So I'm not expecting MicroStrategy to get liquidated, right? But it's just not long-term sustainable. So whether it's this cycle, the next cycle, I think at some point this ends badly, as it did in the 1929 crash for the investment trusts. I think we'll see a big consolidation of this industry. Like you just don't need 200 DATs. The DATs effectively for the everyday person is just another ETF with some yield on it. And we don't need 200 ETFs in anything. We don't have 200 gold DATs or gold ETFs. It just doesn't make sense. So I think you'll get a big consolidation, probably a lot of acquisitions, probably a lot will just shutter. And we probably end with maybe 5 or 10 of these things in the next 5-10 years. And I think they'll become more of a bank kind of investment vehicle than what they are today. I think what you see today won't really exist in a decade.
When you say the debt ratio, what's that ratio?
The debt ratio, yeah, there's a few. There's a few ways to cut it. So the chart I had up before is just average debt to equity, which is a kind of classic way to do it for stocks. I also had debt to Bitcoin holdings, debt to enterprise value. So you can look at it a few ways. And this is, again, a rate of change thing like we were talking about before. The current value that they're at is not deeply concerning. Our debt to equity is hit at almost 1, which is not great, right? Especially for businesses that don't have cash flow, like all the DATs. But it's, if it was 1.5 or 2, that'd be very alarming, I would say. But it's more the rate of change. It's just going up, especially as price goes down. So yeah, it's something to monitor, I would say.
I was gonna ask, like, in terms of risk of these DATs, do you view it in a similar way as last cycle, where we had all these, CeFi lenders going bankrupt, forced liquidations? And I guess the idea was that maybe these DATs were a little bit more formalized and smart money driven.
Yeah.
And yeah, I'm curious if you think it's going to be like liquidation or just a slow kind of drag on like market innovation.
I don't think we're at a point where liquidation is going to happen unless price drops a lot. Like if we, if price is down 40K or something in 2 months, maybe it's a different story. But and it'll probably have to stay there for a while. So I don't think it's a liquidation risk right now when we're in the 60K range. Like I said, the debt ratios are just not that high. They're still very serviceable for these companies. It means they have to sell Bitcoin like Saylor is doing. And that's obviously, not good for price because of sell pressure. The biggest risk in terms of an unwind would be from confidence, right? I think we've already seen that in the last month or two where, I would argue Saylor's not at risk of liquidating right now, but the confidence in his whole model and the structure, and people know that you cannot guarantee 12% yields on an asset forever that doesn't have any cash flows, right? So yeah, people are obviously very concerned about it, and that's forced his hand. Just months ago, he was saying to sell your kidney to buy Bitcoin, or to mortgage your house to buy Bitcoin like a year ago, right? And never sell, right? And now his selling is Bitcoin and his average price is much higher than where he's selling. So he's bought high and selling low. Like, it makes no sense. The whole model is crazy. But it doesn't mean that you have to have a leverage unwind necessarily, unless, price gets way lower, or there's just a massive confidence unwind in the whole structure, which we just don't have at this point. It's harder to have like a liquidation like you had in those crypto events you talked about than these structures. Obviously, there's much more investor protections. As I said, the leverage rate's already lower and more serviceable. But it's just like, a bit of a drag. I think I've said recently, it's like this whole DAT thing is like a ball and chain on crypto. If we didn't have any DATs, I think we'd be in a much better place and price probably be higher than where we are today. So yeah, it's probably just something we have to go through for a while until they kind of consolidate a bit and become more sustainable. And I think the first step of that has probably happened today with some selling of Bitcoin, because Saylor's model just does not work the way it is. If he's smart, he'd probably get rid of all the debt Probably it's not going to happen anytime soon, though.
Yeah, I think you've mentioned AI a few times, and I definitely wanted to get your take on that, and specifically in crypto and how you view it, because we have AI in terms of like technology that we use, and then like the equity markets where there's AI trends, and then crypto where there's, I don't know, some AI use cases or chains or projects that are sort of trying to implement it. So I'm curious how you're kind of viewing the general AI trend.
Yeah, I don't have much to add on the crypto side of it. I think crypto will always try and create a product out of the hot narrative, and most of the time they're not meaningful. So I wouldn't give any value to that right now. Yeah, I mean, AI is massive, right? Like I don't know where to start. Like we've been using AI at Capriole for many years. Even before ChatGPT, we were doing some reinforcement learning work, and we kind of just, for me, it was obviously going to be the next thing that was coming in the sort of late 20s, as in 2020s, 2030 sort of mark being the sort of potential singularity range, where AI is potentially smarter than all of humanity in the next sort of 5 to 10 years. So yeah, I mean, how do you price or value intelligence or super intelligence? It's a pretty hard question. No one's ever had something like this to navigate, but it's pretty obvious that there'll be a huge value unlock from that. The question, I suppose, on the nearer term is the asset class more over or undervalued relatively? And that's more tricky to answer. It really is kind of case by case. There's some equities which are really extended, and historically at major extremes have had 100x run-ups. Obviously, some of the semis and the memory trades. Will that continue? I think you'll need to see really consistent demand on the AI trade, but there can also be a bullwhip effect where we have more supply saturation come online. So we've seen, for example, Apple has been engaging with some of these memory companies in China, which have historically been like blocked for them to use. But if you see a lot of these semiconductors and memory chips trading at huge multiples that they have at the past, you're going to get more people trying to copy that and create supply. And that's where you get some kind of question marks about what will happen in sort of 12, 24, 36 months. And it's not an easy one to project. That's for
Exactly.
sure.
Yeah. I think you mentioned that AI could have been one of the reasons, or the investment opportunity in AI might have been some of the reasons why some capital didn't flow into crypto. And so do you follow specifics on that, like specific metrics, or is it more of a kind of feeling and trend you're seeing?
Yeah, I mean, you just have to look at the market caps. Bitcoin was over 2 trillion, and we've just seen massive influx of tens of trillions into the AI trades and random AI supply chain companies in the last 12 months. So there's that. I think that wouldn't necessarily have been a huge problem for Bitcoin if it didn't have the whole ball and chain we're talking about, which is the DATs and the quantum threat. Because now, in every other bear market, for example, FTX, obviously that sucked. We had lots of frauds and scams, and it was really kind of depressing to go through no matter how you're positioned. But at the end of it, in November, December 2022, prices at like 16K, you look at it and you're like, okay, all these bad actors have been eliminated. On chain, we're at deep discounts and valuations that happen once every 4 years. All the fundamentals are still there. The outlook for Bitcoin is still there. This is an obvious value trade, right? Like for me, it was really obvious. We wrote quite publicly about it and positioned for it. I don't have that for Bitcoin now, right? Like Bitcoin is still in a value zone. It's not as good as 2022. Maybe that will happen in a month. If we drop to 40K, I'll probably be pretty noisy about it. But right now it's in a value zone, which is pretty good. But at the same time, you have to think about, okay, the next 2 to 3 years or 4 years, is Bitcoin going to upgrade to be quantum proof? Not sure if it will at the current rate. Hopefully it will. You also have to think about these 200 DATs that are growing leverage and running a business model that's not sustainable and guaranteeing interest when they don't have any cash flows, and how that's going to unfold. It might be fine, but It's just something you have to think about now. You didn't have to worry about before. Whereas before it was like, okay, everything's been flushed out, and the upside is, okay, now maybe institutions will enter the market. Maybe they'll buy, maybe we'll have ETFs launch in a year, all these positive kind of forward-looking demand drivers, and you just don't really have that right now for Bitcoin. That can change really quickly. So tomorrow, if the Bitcoin core team comes out and says, this is our 18-month or 2-year roadmap to deploy quantum proof upgrade to Bitcoin, and we're working on it right now, it's top priority, like that whole messaging changes completely, and Bitcoin probably jumps 20-30% overnight, because I think the market will just price out a lot of the risk that we have today. So a lot of these things can change really quick, and I would be obviously really bullish if that happened. But right now it's just been like completely kicking the can down the road on all these fronts and outright ignoring some of these risks. And I think most investors see that. You see many TradFi investors talking about that. Even Paul Tudor Jones, he was one of the biggest supporters of Bitcoin in 2020 as the fastest horse, and now he's talking about the quantum stuff. So it's like just something that makes it really much harder to position right now until some of these matters are addressed, especially when you've got this relative trade of AI, which doesn't have those kind of heavy drags on it at the moment.
Yeah, just following up on that. I mean, you're talking about some of the maybe bullish catalysts that you may want to see, like the Bitcoin upgrade into quantum resistance. What other catalysts would you be looking at, for the next bull run to start?
Yeah, good question. It could be a lot of things. One would be very simply price, right? If we kind of reclaim 70K, I think that would be, regardless of what's happening, a telling sign, flipping key levels and resistance amidst all of this kind of negative stuff. Usually if that happens, there'll be something else to back it up as other than just price, but remains to be seen. Maybe it means strategies just sold down a lot of their debt, or they've cashed up a lot, and that has de-risked the DATs. I'd much rather see, I think it's the biggest catalyst would be the quantum one I talked about. It doesn't even have to be tangible action, just some kind of roadmap where key members of Bitcoin Core are aligned. I just genuinely think that is the biggest risk Bitcoin has ever had and has right now. I price that risk today as a discount factor in Bitcoin at about 30%. If you kind of just collate, which we've got now also in our charts and an article where we analyzed it, but basically if you collate all of the top quantum companies and quantum physicists in the world and when they believe Q-Day will happen, 100% of the estimates are within 8 or 9 years, with a high probability around the 4 or 5 year mark. And if you discount that back, assuming no code changes or anything, that's about, there's an article to go through this, but essentially a 30% discount rate. So that's the biggest opportunity, just a roadmap there. The DATs, some kind of change there. It could be a macro factor, right? It could be the peace deal signed in Iran and the Fed's like, we are not raising rates, and it's basically in their forecast roadmap at all. There's no rate raises, and maybe they're even adding money supply to the market, right? It could, or, it could be the whole equities AI trade completely tanks. And then again, the printer turns on. So there could be a few factors like that. It's hard to really guess which one it will be, but it doesn't have to be any of those. But some kind of major factor like that would definitely, I think, really help.
Do you see the strategic Bitcoin reserve in the US being some of that catalyst, or how do you see the probability of that?
Do you see that? Is there news that they're going to be buying soon? Or?
Yeah. I mean, there has been some chat recently. I don't remember who from the U.S. government said that they were working on, all the legal stuff. But do you think that's a well, I mean, it will be a catalyst, I think, but how probable is that?
Yeah, I don't know. I mean, if Trump says they're buying and they actually start buying, I think that would be a major catalyst. Yeah, I wouldn't want to ignore that. But yeah, the extent of it, how long it lasts, all that is very unknown. And if it actually happens, there's been pretty little done there. I saw some rumors as well recently, but there's been very little.
The US election, maybe?
Do you think that will be good or bad?
I mean, depending on who wins, I think.
And we've still got a couple of years, right?
Yeah, but I mean the November election, like if the Democrats,
Midterms.
yeah, the midterms,
Yeah,
Democrat wins.
I don't think it will matter because the market already knows Trump will be gone in a couple of years. So even if I don't know, it'll probably have some impact, right? Like all these events have some impact, but I don't think it'll. I doubt that the outcome will have a measurable impact on Bitcoin.
I did have one, I guess, follow-up question on the quantum risk. I think it's so interesting. I guess I'm curious in terms of like the organization of this, I guess, quantum attack. How do you see it? Do you see like nation states or these private companies, or like how are you viewing the actual risk playing out?
Well, basically, most of the top companies are projecting to have a quantum relevant machine by 2030, 2031. And we don't, basically the short answer, we don't know. For example, we don't know anything about the roadmaps for Chinese quantum companies, but we do know that they have some of the best quantum machines in the world, and they're spending almost double the US on quantum. So it could be that China builds one and then does some experimenting and maybe some attacking. It could just be that these quantum machines are broadly available on any cloud platform. Like right now, you can use a quantum machine on AWS, Google Cloud, Azure, right? You can just rent one user. They're not that powerful, but in 3 to 5 years, they'll be very powerful. So it could just be at some point, basically, as far out as you go, at some point, everyone will have the the quantum power to do what they want with that power, right? It's kind of like the mythos fable thing that we see in AI right now. It's being constrained. So maybe in a few years, quantum machines will be restricted to government level for some time, but eventually all these technologies come out. So it's hard to predict where the attack come from, and I don't think it even need to have an attack. It's just more that the presence of something which could be an attack risker will cause the market to reprice. So, Bitcoin is not going to die. It's not going away. But if you have a major threat of quantum that enough people believe in, it's going to get a massive repricing, probably the worst bear market ever. And then if you do have an actual attack, obviously it's going to be really bad. So the obvious risk is there's a few elements to it, but it's the old coins, lost coins, Satoshi coins, where the public keys are available and these machines can just grind away at them and expose the public key. Google did some research that they think that you could basically do a 9-minute attack, so it could be within the actual blocks, so it affect everyone at some point in the coming years. So it's pretty widespread, covering a lot of angles, and the main problem is just that there's no traction. Like ETH, for example, I think I saw yesterday that ETH had already set up a team to investigate quantum risk and work on it as a top priority, and I think it was yesterday basically laid out their roadmap to implement that in the next 2-3 years. So that's what we need to see, is that from Bitcoin. But at the moment, you still got a lot of the core Bitcoin team saying it's not in their top 100 priorities. So that's a major issue, especially when every asset allocator in the world is looking at this and saying they don't want to touch it until it's addressed. So,
oh yeah, that's super interesting. So not even necessarily the intent, but just generally how AI develops undermines like the fundamental security of Bitcoin. And
quantum, yeah.
Quantum.
And then, we're kind of rounded up on time here, but I had one, I guess, final question I'd like to ask all our guests is really what advice would you give to the average crypto investor? Like what framework could they follow? Because I think we all speak about so many, individual metrics and macro and all these different factors. And it seems like so much to actually like tell someone how to implement. So I'm curious if you had, what would you tell the average crypto to look at?
Yeah, I mean, well, firstly, you have to, I think, just really love crypto and finance. If you've got the passion, I think you'll work it out. But you need to, do a lot of deep research and understand the data and the drivers of everything. I think if you're talking about crypto broadly, most crypto tokens, as we all know, just don't survive. They'll have some kind of hype mania if they're lucky, and then they'll bleed out minus 99% within 3 to 4 years. You can just check any altcoin, and you'll see that in 2025, if you just, there was analysis I was on Twitter, you would have seen, but if you just invested in all of the new listings on Binance, you would have been down 95% on average. So you got to be really careful and sparing, I think, with how you position. It depends if you're an investor or a trader. Obviously, there are two very different ways of managing the capital that you need to consider. But in terms of investing, I wouldn't really invest in anything in crypto outside of Bitcoin unless it kind of has really strong tokenomics and some kind of either, proven revenue, like growth in the product, and ideally a buy and burn. So what I mean by that is a lot of these tokens go down because they have just endless token supply hitting the market, unlocks from VCs or what have you. There's very few have fixed supply or supply burn. Like you could probably count them on one hand, and they're the only ones probably I'd want to first be looking at long term. And then secondly, you need product market fit, and the easiest way to assess that is if they're making revenue and they're growing it. So obviously Hype fits in that category where they've established strong and growing revenue, and they use that to buy and burn a token. So hard tokenomics, diminishing supply, proven product fit, right? That's the best example. There are others that have been in that category at different times. But they're probably the two or three most important things I'd say for crypto if you want to be a long-term investor.
Awesome. Well, thank you so much for coming on. I think you're our third guest at this point. So we look forward to having you on again. Hopefully be near an all-time high.
No, it'd be my pleasure. Maybe this is a nice bottom signal, hopefully.
Yeah. Thanks again. We really appreciate it.
My pleasure. Thanks, Julio and Ben.